Sorry, got distracted. All right, sorry. G'day, mate. How are ya? How's your mum? So, hey, good morning. Welcome to my home office here in Atlanta, Georgia. We gather here today to conduct technical and fundamental analysis with the overriding goal of planning our trades in advance because trading is risky. Not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. Let's go. So, Forex.Today, the YouTube channel of 22,000 foreign exchange traders. Well, guess what? It's a collaboration between Traders and Traders Way. Traders is your analytical tool. Traders Way is your execution partner, or our prime broker. Match made in heaven. Let's get a sit rep. Come on, Aiden. What? There we go. A little slow. So funny how he says that he's Aiden.
Good morning. I am Aiden with Tradars.
With Tradars.
Let us get you up to speed on the current market landscape. Today's market sentiment is currently flat and indecisive, as evidenced by a near zero daily risk score, which contrasts sharply with the broader monthly trend that remains firmly risk on. This immediate hesitation is driven by a climb in the U.S. 10-year yield to 4.41%, which is providing support to the U.S. dollar and creating a cautious environment ahead of critical U.S. inflation data. While the longer-term outlook suggests appetite for equities, the immediate correlation between rising yields and a strengthening DXY is putting pressure on the euro and pound as we head into the European session. 1. Oil prices have jumped over 3% to reach $101.37 as peace talks between the U.S. and Iran hit another impasse, raising supply concerns. Gold is under pressure, sliding toward $4,700 as the market braces for the upcoming U.S. inflation report. Meanwhile, in Switzerland, the franc is weakening as the SNB actively resists currency strength, and in South Africa, manufacturing data showed a nice recovery, rising to 0.9% in March compared to a previous contraction. Biggest movers right now, wheat, corn, U.S. oil, Brent crude oil, and volatility index are up.
Holy smokes, that's good. Wasn't that a good overview? Holy smokes, that was good. I moved the scenario analysis over here to a different toggle so you can see the bull case, base case, and bear case if you want to go through that. And then, of course, the only thing that seems to be moving right now is Kiwi Yen, and everything else is basically flat, so nothing to do right now. Whatever you're looking at is probably fool's gold. And when I see only one currency pair that's worth trading, that means no currency pairs. Because obviously I'm looking for correlation. Yeah. Cool. Let's get an update on headlines.
Gold. Indian demand risks under Modi call. Commerzbank.
US CPI set to show prices climbing at fastest pace in nearly 3 years as Fed rate cut bets fade.
US dollar, yen price. Forecast. Likely extend advance towards 20-day EMA amid firm US dollar.
Investing live European FX news wrap. Yen whipsaws, risk mood on the defensive. Kremlin repeats Putin's assertion that Ukraine war is nearly over after Zelensky casts doubt. US dollar. Range-bound gains as CPI runs hot, BBH. Chart alert. WTI crude is poised for a potential volatility bullish breakout above $102. BBL.
Gold price forecast. Gold Geo US dollar slides to $4,700 ahead of US CPI data.
So as you can see, in 41 minutes and 47 seconds, we got CPI out of the United States of America. And there's our oil Oscar Mike, huh? Jiminy Cricket. Ooh la la. Wheat way up there, corn, oil, Brent, and Nazi. Silver down today. I think it was up yesterday. Bitcoin back down to 81-ish. Look at the drop in Ethereum, huh? Yeah, sell the rip, huh? Sell the rip. Projection by the end of the day, $2,245.73. Yeah. Risk radar flat. So let's answer the poll. Thank you for taking part. Okay, looks like half a risk on, half a risk off. Oil is up. That is bad. Well, we can look at it. Yeah, oil is up. Junk bonds flat. Investment grade bonds. Gold is down. Bitcoin is down. Yep. So still long term trying to move the markets up, but under current market conditions, the irrational exuberance around a deal. Remember last week I was poo-pooing all over the deal. I'm like, there's no way there's going to be a deal. Now there's no deal. So with that, oil prices going up, it's hard to be, let's say, you certainly can't be very risk on. And yet 16% of you are very risk on. I'm like, really? With these assets moving the way they are, that doesn't make logical sense. Maybe you're emotionally very bullish, but you shouldn't be very bullish right now. And even bullish is, I don't know. I think it's kind of like, will CPI even matter? Well, I guess we need to talk about CPI. The subcomponent under real estate, right? The housing, owner equivalent rent that goes into CPI. It's a big component, and it only gets updated in the basket every 6 months. Guess what? It's been updated. And most likely it's going to show higher rent, higher owner equivalent rent. So CPI probably won't be low based on that alone. So even if you look at core and try to strip out energy, because we know oil prices are up, so that's going to impact CPI quite a bit. But even if you take core out, I think housing is still in the core. And right? So I don't think mathematically we can have a low CPI. We should be prepared for that. No, I did not know that. Why? What happened? When I click on them, they work. It's really? So this is me. All right, good evening, good afternoon. Works perfectly fine for me. So that's the risk radar. Let's take a look and see what's moving. Kiwi is a little bit strong, and yen is a little bit weak. Pound is just as weak. I guess you could throw Swissy in there. And remember, we've been talking about Swissy intervention, and boom, looks like we got it. So sell, sell, sell. Maybe buy. Dollar is strong. USD is strong. That is also a risk-off sign. Now, I believe it was quite a bit stronger earlier, so it's less strong than it was. Money is going into energy. Okay, both Brent and WTI are up over 3%. U.S. equity is doing okay in the moment. U.S. Treasury is doing okay in the moment. And crypto is taking a bloodbath. European equities had a bad day. FTSE down, DAX down. Look at that. DAX down over 1%. FTSE's basically flat. They're like, oh, we're going to lose our prime minister again. Boring. Nothing to talk about here. The French stock market down almost 2/3 of 1%, or 0.6%. Asia flat. Risk is flat. Now remember, this is a completely different measure of risk than the risk radar. Well, I guess not completely different, but it is different. The process is different, right? And so for those that are very risk on, well, when we look at VIX and then look at everything that may or may not correlate with VIX, and then take the things that are positively or negatively correlated with VIX, we put that into a basket. So that updates all the time. The basket changes based on correlation changes. And the correlation data set is 90 days. So it's always the most recent 90 days. So it's always changing. So it's not a preset basket. It's actually based on real correlation data, the best data that we have at the time. And so we're looking at that right now. We're looking at 1, 2, 3, 4, 5, 6 markets that are all variables tied to risk. And it's not risk on or risk off. So right now, we are neutral. I've measured it 2 different ways now. The market is neutral. Longer term, we're a 5, which isn't that bullish. So I think I'd agree with you if you said risk on in general, but maybe not right this second. Okay, fine. That's fair. That's kind of what a 5 is. But if you're very risk on, I can't prove it quantitatively. So you're doing something different and unique. Are you that special? Are you really that different and unique? So again, my process, I'm trying to uncover what institutional investors are doing. It's my inside information. If I can see what the professionals are doing, then I want to trade along with them. Well, right now there's no trade. Now, will this change after CPI? I don't know, but if it does, I can see it and I can trade with them. It's a whole different investment strategy than trying to beat the market or make as much money as I possibly can. What is that? What kind of business strategy is that? But by measuring the market, in particular what institutional investors are doing in the market, then I can align my investment strategy with what institutional investors are doing. So I can ride the wave of their cash flows. So right now, Kiwi moderately strong. I mean, 0.27, it's not that strong. Yen is weak, but it's not that weak. And that's why when we can measure all of this quantitatively, that's why I would assume the risk index that I created is okay. Okay, no. Okay, let's talk about this then. Risk radar. Okay? So you're going to make a 30-day journey. You're going to walk across Europe. You're going to walk from London to Istanbul. How about that? That's a long walk. Maybe London to Moscow is an easier walk, right? But okay, London to Moscow. You know where you're going, and if you break things down, you know generally how many, kilometers you're going to walk per day, but we know realistically you're slower in the mountains, you're faster on the prairies. Also, good weather and bad weather impact let's say your kilometer per day. So think of the long term. Like if I said, where are you going? You're like, well, I'm walking to Moscow. And it's going to take the journey will take 30 days. Well, that's what this is. The 5 is a basket of monthly, weekly, and daily. Okay. So there is no doubt you are going to Moscow. There is no doubt the general market is bullish. This is about today. Every day is different. So what you're trying to do is, you can assume if the journey today is generally flat and the weather is generally acceptable, it's not too hot, it's not rainy, it's not windy, it's just kind of a decent day, you're gonna have good yield, right? You're gonna walk an extra distance compared to a rainy day, a windy day, an uphill day. Okay, so every day is different. What we're trying to know is, when do you trade big, when do you trade small, and when do you not trade at all? Now, big and small can be determined as lot size or the number of trades you make. So when you have congruency, meaning it's a bullish day in a bullish month, you should not have fear. Now, if you can't measure it, you might not even notice it. Okay. Now and by the way, you say yesterday we had a risk on and today we have a risk off. Look, a 1.02 is fractionally risk on. And we probably had it labeled as mixed or neutral. Or let's say it was a 3 yesterday and it was definitely risk on. Things have changed since then. Now, this isn't subjective where Aiden says, oh, Trump rejected the peace offer and oil is spiking. Therefore, I think that would be risk off. No, we're measuring dozens of changes in prices. And we noticed things like, you know, stock markets coming down, moves in the bond market, moves in the commodity market, moves in the spreads market, dollar is strong. So all of that adds up. We're like, okay, well, right now, since yesterday, the markets are not risk on anymore. So it's not like these numbers are random and flipping all over the place. Dude, we are not bullish anymore. And for people that miss that, they get run over. They do yesterday's trade again today, and they don't realize it's probably not going to work. We're not risk on today. Things have changed from yesterday. And maybe long term, okay, because our 4.86, I swear a week ago it was an 8. So long term, we're a lot less bullish. Look at weekly, we're flat. Daily, we're flat. We're not that bullish, but we're not bearish. Okay, this isn't a -5. Okay, so we are cautiously optimistic, but we're not bullish today. So for those that said, well, I'm bullish, I'm very bullish. I'm like, I don't get it. Well, okay, when you look at all 3 time frames, we're risk on. We're not strong risk on. Now, I can't say bullish or bearish because it's non-directional, right? It's risk. So we're moderate. This is not a 10. It's a 5. It's less than 5, but it's about a 5. It's not a 13. Okay? So we're moderately, cautiously bullish. And the job here now, and you say, I don't understand, yesterday was risk on, now how do you make a decision? The decision here is not whether to be risk on or risk off. It's risk on. Quantitatively, it's risk on. That's that. So what do you do in a risk on environment? You enter trades when the short time frame has congruency. So if today turns bullish, let's say CPI is amazing and it changes everything. I think it'll change nothing, but whatever. It changes everything. And we have an amazing bullish day today. You need to get in trades because we have alignment of the short, right? Short term, medium term, and long term. And we know when they all line up, an object in motion tends to stay in motion. Well, right now, we're at rest. Okay? We're at rest. We need a catalyst. Is it going to be CPI? Yeah, it could be. Now, like I discussed earlier, I think we got some other things going on in CPI, you know. So I don't know if it, I think geopolitics impacts the ebb and flow daily more than anything. Because I think the economics are really well understood. Have you checked out the new rates radar? We project the Fed doing nothing for a very long time. So who gives a hoot about CPI? Why do we care about CPI? Because it helps us understand the likely monetary policy. We already know what the monetary policy is. We've made 1,000 calculations, okay, because we're analyzing yield curve, changes of the yield curve, spread in the yield curve, right? And we know the implied interest rate by the monetary policy rate by the Fed. We already know that because many calculations were made. The Fed's not going to do anything for a very long time. So CPI today is actually useless, in my humble opinion, because we don't care about CPI. Right? Like, what is it going to tell you that you don't know? oh my God, gasoline prices are high? Really? I'm really surprised by that. Right? You already know, and we already know what the Fed's going to do. What we care about is what the Fed's going to do, because that will change the value of the US dollar. If they raise it, it'll go up. If they cut it, it goes down. Now, that's not always true, in fact. But I think in this scenario might be generally true. But the thing is, if there's no change, then why do we care about CPI if the only reason we track CPI is to understand the change? Well, there is no change, so we don't need CPI. Okay. So anyways, but that might be the catalyst. If it's crazy surprising, maybe today goes massive risk on. Then you swing long. You guys understand this concept? Where you are bullish on 3 time frames. So going for a 20 pip trade is not, it doesn't make any logical sense. Okay? So that's not the decision we're trying to make today. If this goes risk off, okay, go ahead, day trade, intraday trade, market open trade, go for your 25 to 100 pips. Okay, just, it's a down day. Who cares? Now, maybe maybe things change on a bigger scale, but they haven't now. So don't give me maybe. So if today is a down day, you're like, guess I'm risk off for the day, for the morning, whatever, between the New York Open and the London close. You're going to be some risk off. You're going to make a couple of scalps. Maybe you'll squeeze, 50 to 100 pips out of the market over 3 or 4 trades. Great. And then you're done. You had a down day in an up market. However, if you have an up day in an up market, you'd be a fool to go after a 25 pip trade, that tiny little pissy little trade. Dude, we're firing on all cylinders and you're picking up pennies. Like, dude, all right, when the fish are jumping in the canoe, get a second canoe, get a third canoe. They're like, well, I usually only catch 2 and I got 2, so I'm done. Dude, catch the fish when they're jumping in the canoe. So when you have a day where the day is bullish, the week is bullish, the month is bullish, remember, we're doing dozens and dozens and dozens of technical and fundamental and analytical calculations to say, dude, we're firing on all frickin' cylinders. Throw down some swing trades, bro. You don't go for 25, you go for 250 because it's gonna stay in motion. If CPI is our catalyst and the markets wake up and take off, it could just be a relief rally. Oh, it's not as bad as we thought it'd be. Off we go. And now, so you might make some trades and you're long, like let's say we know right now, what would it be a good scenario? Risk on, gold has been moving. No, actually, that's not as true as it was a couple of weeks ago. We have the data on that. But whatever. You find the thing that you want to own, okay? And you stay in that trade for days, maybe even a couple of weeks if you're lucky. Okay, there's a time to be happy with a 25 pip trade. There's times to be disappointed with a 100 pip trade. And you got to know when. Okay, Angel, that's what this is about. Are you short-term short or are you long-term long? Right now, in the first 5 seconds of starting today's webinar, let's see if things change. I'll go to my sit rep. Boy, he thinks too much. Maybe we won't go there. I will index radar. Okay, let's load this. Go to the trade avoid. Okay, good. Look, things have changed in the last 15 minutes. Okay? You have two moderately bullish trades. Both are buying dollar. You have two moderately bearish trades. One of them is buying dollar. One is buying, I think it's Aussie. Actually, that's Kiwi, isn't it? I don't see the Southern Star. Oh, well, it's labeled. Good job, Wayne. See, I look at the flags. I like the pretty pictures. So anyways, look how easy it is to find out what to be doing. Now, that just tells you what's going on right this second. And there was only one trade, 15 minutes ago, and I looked at it and I'm like, it doesn't even look that good. It looks moderate, so I'll pass. Well, it's not even there anymore. Things have changed. It's not that good. But we're definitely buying dollar. Do you see that? Why would we buy dollar? Well, look at that. Dollar's strong. Okay. So buy, sell, sell. You mean this? Yeah. If you prefer, buy, sell, sell. Ignore these 25 currency pairs. It's nice, right? But how do you know the magnitude of the move? Well, we're risk on, aren't we? Yeah, we're a 5, generally speaking. So we want to sell the US dollar. Well, that's not working now. So I guess we're going to buy the dollar for now. We'll see what happens after CPI. If the dollar suddenly flips, and you can just watch this, it'll just go green, neutral, red, and it'll be down here. So if dollar falls, we're swing trading, Angel, because we're bulls. Yeah, baby, yeah. And we're going to be long all the way to Friday. Short the dollar, but long whatever we're shorting the dollar against, right? Yeah. So, like, I might be long NASDAQ all the way to Friday. Risk on, baby. So, 25 pips on a Aussie USD trade would be ridiculous. And if you're not interested in shorting the pound right now, like, dude, what is it that you're trying to do? It's our weakest currency. Shouldn't you be on pound dollar? You're like, that's, oh yeah, is there an easy way to do it? Yeah, pound dollar. Sell it. Look at our conviction. Dude, pound is weak, US is strong. Strong versus weak, huh? Down. So now you can just sit here. But again, you have to understand, are your general bias. My general bias is risk on. I want to sell the US dollar. US dollar is strong right now. So I can buy it for today, but that's not really what I want to do. So my other choice is just wait for dollar weakness. Is it weak now? No. 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 But if it turns weak, I start trading like a confident trader, and I let those winners run. If I do that, if I wait for the pullback, which is happening, and then I see dollar weakness, I start selling that weakness. So I start buying Aussie dollar as US dollar falls. And I do it with conviction, and not only do I get into the trade, but I pyramid, right? I build positions. That's the style of trading that I like. Is, I prefer to buy a little Aussie dollar long and then buy a little more Aussie dollar long, and then buy another Aussie dollar long, and then buy another, another, because eventually I get the same amount of exposure. Let's say I have two choices. Let's say one standard lot or 10 mini lots. I could just buy one standard lot, but my timing might be wrong. And my drawdown is going to be very expensive because it's one standard lot. So, 100 pips is going to cost me a lot of money. Oh my God. Now, instead, if I do one mini lot, 100 pip pullback, which shouldn't be likely because of my analytics, that would be very improbable. That's what I love about trading with data. Anything could happen, but it'd be extraordinarily mathematically improbable. You might as well lock yourself in the basement with Grandpa Joe and be afraid of everything. The sky's falling! Okay? Yes, you might go outside and get hit by lightning, but, it's not raining, so that's unlikely. Okay. So now we know when we can build up and have 100 pip stop, and we know we're very unlikely to get knocked out. But if we did, it's only 10% of the loss that we would have made. But if we're right, and we probably will be, again, mathematics, we'll probably be right, and it'll go up for a while, come back down, and you remove the risk on the first trade, and then you add another mini lot. And then it goes up and comes back down. You remove the risk on the second, and you add a third mini lot, and a fourth, and a fifth. Now, it takes a lot longer to build your position, but you never take the full risk. You're always risking 90% less, always. And you build up to the position, because if you're right, like I said, you should be right for days, weeks, even months. Yes, with traders, you can look months in advance. Yeah, you can. What we call seasonality. Right? So like we looked at an asset yesterday and I'm like, oh, this one's working, probably will go till the end of June. We could see it. That would be probable because we have 20 years of data that says, yeah, well, that's usual. And it's doing that right now. You see? So if you can see a little further and a little bigger, and that's where the 30-day risk number, the general basket of daily, weekly, monthly, we're at a 5 right now. It tells you that we want to get long if possible, and that we have to look at what's happening right now. And if we have congruency, have some confidence in your trading, build positions, let your winners run. If we lack congruency, something changed overnight, and we know that is geopolitics, but if something changed overnight, we will see it in the data and go, now's not the time to build a position. So we can counter trend trade, maybe as a hedge, or maybe just because we're bored. Maybe we can pick up a few pennies today. Great, great, great. Your job is to trade. You're a trader. But you're short-term short versus long-term long. And that is a huge difference. And most amateur traders don't know what they're doing. So now you're like, yeah, okay, maybe a dollar strong today. Yeah, all right. Stock market's probably going to have a pullback. Great. So maybe you sell some Dow, you buy some dollar, you sell some pound today. Maybe Kiwi yen. Okay, you go long Kiwi yen today, and you're like, okay, all right, fine. Dollar's strong, but Swissy and yen are weak, and they're supposed to be weak. So the other way on how is you're like, all right, well, I want to see dollar weakness. We clearly don't have it. We clearly don't have risk on right now in the moment. This could be different in 20 minutes. But right now, it's not risk on. So you're like, well, I'm building positions in Kiwi, Swissy, and Aussie Swissy. And Kiwi yen and Aussie yen. And you're favoring Aussie over Kiwi. Even though Kiwi's stronger today, if you go to fundamentals and we go to our rates radar, I think he's calculating it every freaking time I load it. I'm going to have to. Sometimes you have to tell AI, hey, I asked you to update this monthly. Or, sorry, weekly. Why are you doing the calculations every time I load the page? Do the calculations once a week and then display a cache. So, anyways, I got to do that. I got to speed it up. So we were looking at carry trades. Okay. The best is Aussie Swissy or Norway Swissy. USD Swissy. Hey, dollar strong. Maybe you can get in a trade, jam the stop, and I don't know, maybe you get lucky. Maybe the dollar's strong for the next 6 weeks because the economy collapses or Trump starts bombing Iran and boom, dollar's ripper strong. I don't know, give it a shot. But here's the thing. If that happens, guess what? Your USD Swiss franc's going to pay you a nice carry, probably for a long time, because the US dollar would get strong in a risk-off environment. We know that's true because I can prove it mathematically. Right? We have all the quantitative data using the Pearson correlation coefficients. Right? But also, Swissy would likely to get strong too, and we're already in the middle of intervention by the Swiss National Bank to weaken it, which you want in a carry trade. So they're likely to jump in and maybe even cut interest rates to negative. And this would be a winner-winner chicken dinner. We know the Fed's not going to cut interest rates for a very long time. You're like, we know that? Yeah, here it is. Okay. So right now, down is more likely than up, but notice it's so little percentage-wise that, if there's a 5% chance of a cut, there's a 95% chance of no cut. Okay. Maybe I'll have them reverse engineer and say it that way. And then maybe slightly increase in the future. But you can see maybe one hike. Okay, maybe one hike by the middle of next year. And then a cut. Maybe. That's just what again, this is not opinion. Well, I guess it is opinion. We're reading the market. This is what the market is showing by analyzing yield curves. Okay, so you see we drop. There's a slight, this is the implied rate. So we know the Fed raises and lowers by 25 basis points, and this is the upper bound. So the next cut would drop us to 3.5. The next hike would go to 4, and that's, you'd want to look at that analysis. Nice.
Spike alert. 1 minute until United
Spike
States
alert.
Consumer
1
Price
minute
Index
until
is
United
released.
States Consumer Price Index is released.
Sorry about the double voice. I have it open in the background. So anyways, on hell, I hope that was helpful. You're like, I didn't mean for you to talk for 30 minutes. Well, there you go. Careful what you ask for. Yen now very weak. Cool.
Spike alert. 1 minute until United States Consumer Price Index is released.
Yen weakening. Aussie now at 0.34. Oh, man, he was able to get the number recently. Oh, 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 oh. Look at, wow, Kiwi just jumped. Yen weak. Aussie yen, Kiwi yen are probably doing very well. Dollar fell off a cliff, huh? Looks like he's not going to pull it. Too bad. He's been able to do it sometimes. I guess it depends on the central bank or the stat agency. Remember, they're all different and need different programming. Well, anywho, cool. So that's how you read all of this stuff, huh? So, do you ever see us getting down to 3.5? No. Do you ever see us getting to 4? No. Three and a half there, maybe. I have to double check if that's even real. So, anyways, we know quantitatively very, very unlikely the Fed's going to cut, and therefore we're going to stay at that high rate. And Switzerland is already plausibly going to zero or negative. Cool. So let's get an update on what actually happened.
United States Consumer Price Index Core SAA up to 335.423 in April from previous 334.165.
Breaking U.S. CPI inflation jumps to 3.8% in April versus 3.7% expected.
U.S. April CPI 3.8%, YY versus 3.7% expected. United States Consumer Price Index ex food and energy, year over year, above forecasts 2.7% in April, actual 2.8%. United States Consumer Price Index ex food and energy, MOM, above expectations, 0.3%. In April, actual 0.4%.
ADP near pulse showed a gain of 33K in the current week. Japanese yen. Intervention risk stays elevated. MUFG. UK retail sales decline, BRC. Cool. And just so you guys know, one of the features we offer is our Squawk Box page where you can chat
United States Consumer Price Index Core SAA up to 335.4
with fellow traders. So you can sit here, you can watch Bloomberg TV, you can listen to the news come in, you can get your trading ideas, you got the calendar rolling, you got live prices, you can chit chat with your buddies. Sometimes what I like to do is have a Bloomberg running in the background. So I hit play and then I just minimize this, okay? And I go and I do my chart. I do my trading. I can just hang out. So it's pretty cool. Ba-da-da, do-do-do. There's a nice little higher, high, higher, low. Do 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 do. So dollar strong today, right? However, are you a bull or a bear? That's why we're talking about using the TradeR's tool to analyze a question like that. Get my pen here. Okay. So, for example, I'm a bull, but it hasn't gone up for a week. But I'm a bull. So what I'm actually trying to do is I'm looking for support. I'm one standard deviation below a mean. I have a pivot. I have the role reversal. So now what I want to do on Hell is watch and see if Aussie dollar. Now, I'm already bullish Aussie, so it'd be like dollar's strong today. So if it weakens, I'm going to go long. This is a 4-hour chart. So am I going to go for 25 pips? Heck no. So I'm going to go long somewhere around 72. And my minimal acceptable performance is 73.5. So if I can't make 150 pips on this, I will be disappointed. But what I'm trying to do is allow it to run even further than that. That's just in the short term, 150. If I can't do that, then I'm not fulfilling my potential. Now, of course, I can make 9 trades over the course of the week in that same direction, but I know the journey and the destination for the week. Okay, that should take a week. And then I want to buy the next dip. Oh. Okay. Cool. So May is an up day for that pair, or up month. And then we go through a cooling off period, so I got to be careful. So I can be long until about the end of May, so I can be a long. I might only be long for a week on that trade, actually. Looking at this, I'm like, oh. 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 All right. All right. So peak and then down, 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 down. Okay, good to know. We're forecasting it as kind of flattish this year. So even though we have 20 years, we're like, okay, but we're in the trend. And if US dollar stays weak, but Australian dollar weakens because of seasonality, because maybe it's winter and that the economy slows down. And so if they both remain weak, we should stay till middle of July, and then we'll have a pullback, and then around October start buying it back. You know what? That is what I would do if I were me. And I did not tell Aiden to do that. But you know what? That's what one of the things I think is so extraordinary about traders is that is what I would think if I were. I have that in my brain. Now, I don't know the level of accuracy that my brain has, because humans like to remember generalities, rules of thumb, general patterns. This is quantitative. This is what Aiden comes up with when doing the math. And there's a lot of math here to get the shape of a future yield curve. And look at, we're also doing volatility analysis. So, but this dotted line, yeah, that totally 100% makes sense to me. And yet I never told Aiden to draw the line that way. I taught him to look at this math, look at that math, do this math on top of that math. Here's all the different formulas you want to use and put them together. And oh my God, if you looked inside my head, you would see this. Yeah. Cool. So maybe I'm long for a week or so, huh? Or you could just guess